Hey guys, this is Lance from ThetaTraders.com. Just going to do a quick video on volatility and looking at the historic VIX levels. Right now, volatility is very high, and there's a good chance that it could mean revert down. Just going to look at some of the data. Let's get right to it. Alright, so this is a chart of the VIX levels in the last few years. A few of the trends that you want to see here, and this is in the weekly chart. Whenever we have a VIX spike, so here's a spike, you notice how it dropped down pretty quickly, like a week after, just kept selling down a few weeks after. Another VIX spike, big drop a week after. So it's a pretty common trend when you see a VIX spike. Goes up, comes back down, goes up, comes back down. Sometimes it could take a bit of time. Here we were up to around 36. Took a couple of weeks before it got down to the 20. Then it did shot back up to 33. Took a few weeks to go back down. And then here, a lot of steadily down moves. So volatility will typically mean revert. The average volatility, depending on the mean or the median, is either 17 or 19. So eventually we will get back to that level. We don't know exactly when that will happen though, but it will happen just based on historic trends when you see volatility dropping down. August 4th was a big one. The daily volatility went up to 65, but then by the end of the week, we'll zoom in on this red candle here. So on that Monday, August 4th, volatility shot up to 65, but by the end of the week, it dropped down to around the 23, which is just slightly elevated VIX. Right now, at the close on Friday, we ended at 45. Who knows what's going to happen? It could take a couple of weeks. We might be in a sustained level. But just based on historic trends, there's a good chance that volatility will drop. A few of the macroeconomic trends, if Trump lowers his stance on the tariffs, if different countries decide to negotiate on their tariff rates, then there's a good chance that it could drop very quickly. However, if those things don't happen, we could stay at an inflated volatility for a while. To take advantage of things like this, you could buy SVOL. That one, they will look for lower entry prices. This is what I personally do. Is whenever we have volatility spikes, I get in at a lower cost basis. The dividends are monthly paying, and it pays about 17% per year. Right now it's paying 0.27 a month, and the current price is around 15, so it's a good dividend return. If you just compare SVOL, right now we have the big drop, and then volatility went up. So whenever we have high volatility, SVOL tends to go down, but then when a mean reverts, it tends to come back up to that level. So if you look here in July, stock price went down around 20. That was because of the August 4th and 5th volatility spike. And then when volatility came back up again, the SVOL price went up as well. So this is just a personal strategy that I do with buying SVOL whenever volatility spikes up. So then you could buy more shares at a lower cost basis. And just remember that volatility will tend to mean revert. Sometimes it could be very quick. Sometimes it might take a while. I hope this helps, guys. Let me know if you have any questions, and I'll see you guys on the next one.